Good morning, everyone. It's 10:30, so want to start promptly and keep us on schedule. Appreciate you joining us today for a webinar series that OTA Compression and OTA Environmental, co-sponsored with the Permian Basin Petroleum Association, has been hosting for several weeks now. As you know, in the past weeks, we've had some very diverse topics from most recently COVID and the effects that that has on industry and starting things up. We've had topics on bankruptcy, on facilities issues and low price environment, environmental issues. Next week, we have a really interesting topic on rural healthcare, the effect that the low oil price and what's going on with all the layoffs we'll be having with our healthcare system throughout the in the rural areas, something you don't think about much, but has a huge effect on the workforce and on an industry or a region's viability. So be sure and tune in there. For each of these presentations, we also have a YouTube channel with all of the videos. So if you've missed some of those and want to listen in, then reach out to a PBPA or OTA representative, and we'll get you the instructions on or the directions for the YouTube channel location, and you can pull the videos and see those. We also have coming up after the rural healthcare, we have one on private equity. David Hayes with Natural Gas Partners will be speaking on kind of what is going to happen to private equity in this world. World of low oil price and capital constraints and things like that. But today, I'm very, very happy to have James Wicklund as our guest. I've known Jim for quite some time, always find him very, very interesting. He has a background as a research analyst, but has gone to the other side, and he can tell us whether that's the dark side or the good side of doing investment banking for Stephens. Every time I hear him talk, I learn something, and so I think you will as well, and we'll be glad that you're part of this. So with that pressure, Jim, to perform, I will hand it over to you with a real puffball question, talking about, you know, obviously the last 6 months have been amazing from COVID and oil price. What's that going to do to the oilfield service sector? What has it done? We kind of know, but what will it be doing? And then what is its effect on the E&P sector?
All right, and Grant, thanks for the opportunity to talk today. The impact on oilfield services is really going to be dramatic. You've had the rig count drop by 700 rigs in the last 12 months. From 948 or so to 266. That's got to be one of the fastest drops in history. And while the drop from 14 to May of 16 was pretty dramatic, the problem is this time we haven't recovered. Usually when we have these dramatic declines in rig activity, it's off a level where we were all doing pretty well to start, and it always hurts when things go south, but you had started from a better place. This time we hadn't really had much of a recovery when we got killed again. The 266 rig count for last week is the lowest rig count in recorded history. And it's actually the lowest rig count since Abraham Lincoln was president, which is stunning when you think about it. And it's going to be bad the rest of this year. The rig count hasn't bottomed yet, but it's pretty close. And I think you'll see a couple of rigs added by the end of the year. The bigger E&P companies that had 35 rigs and cut to 0, they'll add a couple back. So I think the rig count will bottom here in the next couple of weeks. And over the course of the rest of the year, it'll start to recover, though very anemically. The frac spread count has already bottomed. It bottomed at 45, and it's already at 70 now. And that's because you're actually seeing, for the first time in a number of years, we're actually completing DUCs now. We spent several years building the DUC inventory, and everybody always wondered what it would take for the DUC inventory to start to be worked down, and now you're seeing it. Oil price is low enough and the future strip such that drilling new wells doesn't sound like a good idea, but if I can put production on with just the cost of completing the well, that's basically half price. Now, the return feature is still an issue. That well costs a certain amount of money at one point to drill, but right now the industry is in survival mode and generating as much cash as they can, and that's the near-term answer. And so that's what you're seeing in the frac spread count. I think that 21 will be better. I think oil prices will be higher, and we're all surprised by where the oil price is today. If you'd have told somebody a month ago that oil was going to be 40 at the end of June, they'd have thrown you a party. A month ago, oil didn't hit 50 in the future strip till 2028. And so now it makes everybody easy to say that the oil price was wrong. But I still don't see us getting back to a 50 or 60 or $70 oil price anytime soon. It is good that demand has picked back up now that the worst of COVID appears to be over. Aviation fuel, of course, is still an issue. Nobody's flying. People are driving a little bit more. So it's nice to see that demand has bottomed and it's coming back up. But this is akin to the patient isn't going to die anymore. That had been the fear for a couple of weeks. And now the patient's not going to die. They're not well yet. But it's amazing how not dying when you were dying is a really big sea change in attitude and sentiment. And so the sentiment has definitely improved. The Oilfield Service Index in the last 3 months has doubled, but to put it in perspective, it's still down 75% year to date. So the volatility is extreme. The biggest concern I have really is with the E&P industry, and I'll dovetail that into the follow-on. The E&P industry is going to see significant consolidation because it's going to see considerable bankruptcy. Deloitte has a study out saying that there's going to be $300 billion worth of write-offs by the E&P industry this year. That's the value, that's greater than the value of Exxon. I mean, that's stunning in its magnitude. And the problem is the E&P industry always needs capital. That's, why energy investment bankers were always happy people. The E&P industry has an unlimited need for capital. Well, for 150 years, capital came to the oil industry if the industry promised production growth. I'll grow production, you give me money, we'll create value, and everybody will be happy. And that worked for a long time. And then when the shales came about, there was a great deal of question as to whether the shales would be economic, but there was no question that they could produce. But over the last 10 years, the E&P industry has actually lost about $100 billion in value from outspending cash flow. And in aggregate in the last 10 years, they've lost, bottom line, about $36 billion in net income. And now investors are saying, okay, you're no longer a growth industry. Renewable, Tesla, maybe growth vehicles, but the oil industry is not really a growth industry anymore. It's a mature industry. And as a mature industry, I want to see return of and return on capital. That means that for me to give you money, you have to show that you're going to be profitable and start returning some of my money, dividends or buybacks, over time. Well, in the last 10 years, when we grew production as dramatically as we did and lost $36 billion during a period of time where the greatest efficiencies were wrought ever seen in the oil and gas business, that tells me that we're not going to continue that level of production or that level of production growth, because the people who are losing money during that period of time will have no access to capital. And this is the equity markets, the debt markets. Banks are currently cutting their resource-based lending to oil and gas companies. One company had theirs cut by 14%, one by 30%. And so they're losing access to capital. And so going forward, only the companies, the basins, the areas, the wells that generate a positive return on invested capital, not the promise that one day it'll be worth more and I'll overspend what I'm generating now. It's you have to show a profit on what you're doing today and what you're going to do tomorrow. And that isn't going to be everybody. And so as a result, the recovery is not likely to be back to the same levels of activity we saw year and a half ago when the rig count was over 1,000, because a great deal of that activity was non-economic, and non-economic doesn't bring in the cash anymore. And so that, I think, is going to be the biggest issue. In bankruptcy, if you own property in the Permian and I own property in the Permian and Bob owns property in the Permian, we can all combine and have pretty much the same people running our stuff in the Permian. And frankly, I don't need you and Bob because I'm paying you guys too much. And so I can get rid of SG&A by consolidating these 3 Permian oil companies. And so it makes it very easy to consolidate through bankruptcy the E&P industry. You don't care who owns the property that you're working for as long as they continue to hire you and pay you, right? Who ultimately has ownership is somewhat moot. And so the E&P industry will change from the equity ownership who owned it before to the creditors who will own it now. They'll consolidate. There'll be fewer companies. There'll be bigger companies. But in the field, not much will change. In the service sector, it's different. If I'm a pressure pumping company, owning more pressure pumping assets today is not an asset. It's not a positive. If I own workover rigs, going to own pressure pumping equipment or buying compressors is not a synergistic way to operate. And so because the service industry operates in operations as opposed to land-based locations, it's going to be a very difficult and different world for the oil service sector relative to the E&P world coming out of this.
And take that the next step. It'll be more difficult. So does that mean they just do Chapter 7 instead of Chapter 11? Or what do those service companies that, if you can't get the benefit of consolidating service companies, and what is because they need capital too?
Well, it's been interesting over the last 3 or 4 years. Bankruptcy has changed from what it was in the past. It used to be that when you went bankrupt, you went broke, you closed everything down, you sold your assets, the management and business ideas that didn't work go away. And it's kind of like heaven. If you don't have hell, heaven doesn't work. If you don't have bankruptcy, capitalism doesn't work. But for the last 3 or 4 years in the oil service business, the only difference has been is the ownership has changed. The company may go through bankruptcy. The people who own the equity before get wiped out, and the people who own the debt now own the equity. But people in the field, senior management, assets, operations, nothing's changed. They've continued to operate. And the problem is, since they've gone through bankruptcy, they've written down those assets in terms of value. So now I can charge less for my assets that have been through bankruptcy than you can, and I can generate a higher return on invested capital. So it's a win-win. And so that's the problem. You didn't weed out the weak players. You didn't take out the stranded assets. This time there appears to be at least more chance of more of that. The bondholders are saying, look, I tell you what, liquidate me. I can't get 5 cents on the dollar for your assets. I'll take 4 cents on the dollar, get me out. I'm missing opportunities in tech and healthcare, okay? People who invest in energy have other alternatives of where to invest, okay? And over the last 4 years, they've been somewhat willing to convert their debt to equity. But today, very hard to find. It's very hard to find capital, period. And it's very hard to find debt holders who willingly embrace, sure, I'd love to take equity and take the risk again. And so it may be more 7 in liquidation this time, Grant.
This is kind of tied with that because 3 or 4 years ago when things were in trouble, banks were just kicking the can down the road from a E&P and service. But I think I'm hearing you say that they're not going to be as willing to kick those cans on either of those sectors down, that it's going to be a much more finite resolution.
That's correct.
To the financial stress.
That's correct. That's correct. It's if the president of your bank comes in and says, okay, what happened to those bad loans? Well, now it's bad equity. I'm sorry, you're fired, and we'll get somebody in here who understands what banking is. You keep lending money to people who don't pay you back. I mean, we've got several companies that are going to have to go through a different bankruptcy because they've already been through 7 once in the last 7 years. Hercules did it. There's several more. But there were 153 bankruptcies in energy in the last cycle. And I know of 2 CEOs who lost their jobs and that's it. And so there needs to be a different strategy of bankruptcy this time. And I understand that this caught everybody by surprise, and it wasn't all weak management or bad business decisions that ended up putting companies into bankruptcy. Okay, but there are situations that made it worse, and some situations that made it better. It was some who decided I could handle a little debt, and some who said I didn't want any debt at all. Some who said a little bit of debt ended up being a lot of debt. So people get educated in this, but because I don't believe activity is going to go back to pre-COVID and especially a year ago levels anytime soon, it's not going to be the people are saying, well, I'm just waiting for the really strong rebound that we get every time this happens. I hate to be the one who says it's a little different this time, but it is going to be.
Well, and so what you're also saying is that there's consolidation, that means acquisition. And one of the questions that we've had and wanted you to visit about anyway was the potential for more acquisitions, more consolidation, some of that through bankruptcy, but on a pre-bankruptcy, if you're heading that way, you might want to sell some assets to survive a little longer, or you're going to be forced to. Talk about the acquisition market on service and the E&P side. What you think could happen in light of capital, bankruptcy, cash flows? There's a lot of factors here.
Well, there's definitely going to be consolidation. That's easy. And we mentioned it's going to be a lot easier in E&P. It's going to happen in oilfield service as well, but it's difficult. If you and I would have a great benefit in terms of locations and synergistic cost and ability to reduce overhead by merging, that's great as long as you have a pristine balance sheet and I have a pristine balance sheet. If I have debt problems and you have debt problems, that's too much baggage to make a marriage, okay? And that's the problem. I've got 12 or 14 public companies that could merge with, Miss America if she showed up. And they're the only ones. And most of the sector has too much leverage, debt coming due too soon, debt trading at too far of a discount to make that boost up to par economic. And so the problem is you don't have enough healthy people in the room to carry off a whole lot of constructive marriages. Now, there are some of the larger companies. Well, every company is deciding what it wants to look like on the other side of this, okay? And a lot of the big companies are saying, okay, there's some places where we've been in the past and maybe we don't want to be in the future. There are some businesses that didn't pull their weight in terms of return on invested capital, and we're going to get rid of those. Maybe somebody else can do a better job. And you're going to start seeing some of that. You kind of already have, but it's getting ready to start even more so. The companies that have realized, okay, I'm going to have to restructure fairly soon, that kind of stops you from fire sailing anything. Most everything that's been on the market so far has been distressed. And so nobody wants to buy somebody else's distressed assets at this point.
Now, is that service you're talking about, or E&P, or both?
Mainly service. Some E&P, but not much. If it's distressed E&P, it's in the wrong spot. Nobody's fighting to buy property in the wrong spot right now. The E&P industry is amazing. Somebody else can always operate it better than you could, but nobody's willing to step up and push that hard right now. So it's mainly in the service side. And so you've got some of the big guys saying, okay, I'm shedding some things that pull me down, or geographic areas where I want to be. Baker Hughes has noted onshore U.S. upstream, we don't consider absolute core. International, whatever we're doing in Saudi Arabia or for LNG, that's core, okay? But these companies are looking to see what they're going to sell and what they want to augment. I want to have more technology on the ground in Saudi Arabia, and I've already got an existing network. So find me products that I can plug into my network and boost my incremental income and margins. Those types of things are starting to happen.
Now, you're referring to Baker and much larger companies, but clearly the Permian is full, and our audience is South Texas and Oklahoma also. So we're just lucky to have the Permian Basin Drilling Association as a co-sponsor. But the but a lot of those regions have much smaller players that are even more limited from a capital standpoint, more limited with their options. Can you address how do they handle this current market? These little, the
This is easy, and it's actually easier for them because they're generally private. Okay.
Yes.
And if they're going to go bankrupt anyway, there's not much that can be done. But before you do that, consolidate. Put 2 or 3 or 4 companies together. Hang out at the Midland Country Club with a sign that says, "Let's get together," and get Bob, Fred, and Johnny to put their 3 rental companies together, close 2 locations, and compete as best they can. I mean, this is when you see medium-sized companies that can compete start to form. We're not talking Schlumberger, Halliburton, Baker Hughes. We're talking the second layer down. This is when they start to form. National Oil of Arco is a combination of something like 72 different companies. When they first started that, they were smaller companies that they were putting together. And so, to be perfectly honest, it's more incumbent upon those to consolidate, and it's easier to do so. You don't have a public company board or public shareholders to deal with. You usually don't have huge amounts of debt because nobody was willing to loan smaller private companies huge amounts of money. They thought it was a bad thing a couple of years ago. Now it's nirvana. And so everybody has to swallow their egos. My company's worth more than that. Well, so's Bob and Johnny's. Their companies are worth more than that, are and will be soon. So you have to get rid of the ego. Mine is a better company. I have better people. I have better customers. You know, having none of that is not good. And if you stay small and undercapitalized and lack scale, then you're going to lose. And especially in the Permian, where you've had companies like Concho and you know, continue to make acquisitions. Pioneer's getting nothing but bigger. Exxon, Chevron. It's going to be the purview of the very large E&Ps and the majors. And if you're not big enough to be able to economically support some type of ESG and safety function, you're not going to work for those people. And so you're going to end up working for the Jim Bob exploration companies, which is nice, but you're going to be at the end of the whip in hypercyclicality because they're the first ones to shut down when things go bad. I mean, right now, if you had a 4-year contract with Exxon, I'd be in Vegas, you know, celebrating right now. That's where people want to be. What do you have to do to work for Exxon? I have to be bigger. I have to have a proven safety record. I have to know what ESG stands for. And I have to have backup for something they use if it gets broken. How do I do that? Band together.
I mentioned that in a couple of weeks, we're going to have David Hayes with NGP talking about future private equity. I'd love to get your perspective and whether that's private equity on the service side, because there's quite a few dedicated funds there, but also private equity on the E&P side. You've mentioned some consolidation, but sure seems like it's going to be hard for them to keep raising money, but I'd love to get your input on that.
It has proven very difficult for them to keep raising money. And it definitely stopped them from raising money in the amounts that they initially, when they launched a fund, had hoped to raise. So, like I say, people aren't dying to throw money at people because I'm going to go buy oil and gas or oilfield service businesses. That's not, you know, you don't walk into the bar and pick up the prettiest girl in the room by saying, I'm in the oil business, who wants to invest with me? That's a liability. The private equity firms in E&P sponsored a huge number of teams that went out and made acquisitions in different places. They accelerated their drilling to build value. And then the idea was to monetize those by either taking them public or selling them to an established company. Well, the problem is Wall Street for IPOs and secondaries has been basically closed now for a couple of years. As I say, banks are cutting what they're doing. If you look at where debt is trading, public debt is trading in the debt markets. Again, people aren't fighting to own the debt of companies out there now. So issuing new debt is a challenge. And so to a large extent, the private equity guys are stuck. They can't monetize the investments that they have, and they can't raise additional funds. SCF Partners still has $500 million left from their fund. And that's a bragging point because nobody else has been able to do something like that in a while. That's a rarity. And so private equity definitely cannot come riding to the rescue at this point. And there might be some distressed funds that come up to come riding to the rescue, but those are kind of vulture funds, not the ones we hope to see. E&P is, again, easier. NGP can jam 4 E&P companies together. It can't jam 4 service companies or midstream companies together in the same way. And so, again, it will be easier for E&P, but they're consolidating management teams and saving SG&A. All of the private equity firms are, as much as they can right now, just to keep their heads above water.
But consolidating those, squishing them together, as they seem to like to say, is that just simply kicking, as I keep saying, kicking the can down the road? What does that, yeah, it saves you some money, but what's the end game of that?
Well, end game is hope. Is live to fight another day. It's live to fight another day. The banks gave them a free ride, kicked the can down the road on redeterminations for a long time. Last October, they said, okay, we'll be nice this time because oil price just dislocated dramatically, and that was just probably a one-time event. Now it comes this year, April and May, and they're going, okay, come to Jesus. I mean, oil hit minus $37. You can't ignore that. And so now the banks are actually having to be difficult about it. And so the private equity, everybody, you can still try and kick the can down the road, but you don't have nearly as far to kick the can, and it's harder to do. But live to fight another day still works. If I can cut $5 million from 4 different companies on combined SG&A, that's $5 million more of EBITDA than I had yesterday.
So I think I know the answer, but I'll still ask the question on, if you're a company and you do need capital going forward, what are the options? And
well, there is capital available. That's one of the things we do. We raise capital, we sell companies, we buy companies, we raise capital. And so it's still happening. It's just so incredibly more difficult. There are so many fewer pots of money that are actually willing to do anything. The best thing that will happen is for the rig count to stabilize. The frac spread count already has. If pricing and activity can stabilize, then nobody is afraid of catching a falling knife anymore. And while it may stabilize at a really lousy level, at least you have stabilization, and that's where things can start to get done. And so that's the hope, that you can extend long enough. But to your, how do you raise capital? Goldman Sachs and Morgan Stanley don't care about you anymore. You're too small. And so you look to the smaller shops and smaller houses. Stevens is one. And we raise capital for people and we sell companies. It's just, I'm having to work harder than I did 6 months ago.
very good. Well, I see the time, and we've got one more question. Let me see what that is. Let me just ask this. For years, production and growth were driving metrics for lenders. And now that the industry correction has taken place, what are the major metrics for access to limited money other than EBITDA?
Excellent question. Return on invested capital, ROIC. I asked the CEO of a major oilfield service company a couple of months ago, who was talking about cash flow. And he said, we have a lot of cash flow. And I said, what return on invested capital does that cash flow represent? And he didn't know. He does now. So it's great that you're generating cash. If I get 130% of my cash back in 2 years, I'm a happy guy. But if you're just giving me cash back, I can invest $1 billion. And if I get $100,000 a year in cash, that sounds really good, but it's a really crummy return, right? So if you don't have a positive return on invested capital, that means profitable on the bottom net income line, your access to capital is going to be exceptionally limited, regardless of what your EBITDA is.
Fantastic. That was a great question. I agree. So it's, well, we're in our time here. Jim, I'm very happy to announce that you've done 2 things for me. One is prove me right that you're always very interesting and add a bunch. And then second is you now made my backdrop behind my web look interesting compared to yours.
Yes.
The picture of your ceiling we need to work on, but we'll get you ramped up at some point. So to everyone else, again, appreciate Jim Wicklund with Stevens being part of this. If you've got questions for him, he's in their Dallas office, or reach out to myself or to Stephen Robertson at Permian Basin Petroleum Association. If you need videos of any of this, I'm happy to share that as well. Next Wednesday is the Rural Healthcare, and then the Wednesday after that is the Natural Gas Partners presentation. So Jim, thank you again, and to everyone, have a great week.
Thanks, Grant.